Namaskar. Today session number 23 we will be discussing about international capital structure in the capital asset pricing model. This is primarily a part of corporate finance and integration of foreign exchange in corporate finance. This international capital asset pricing model, we generally call it as international corporate finance, where the capital structure of company generally influenced by their diversification of capital structure. Diversification here means they are sourcing their capital from different countries in foreign exchange. When company sources their capital structure from different countries, the domestic capital asset pricing model will not be valid, because here the domestic market is not only influenced, but also significantly influenced by the international capital market, because the foreign exchange or the domestic international debt and international equity market influence the beta of the company. So, here we will be discussing how the domestic capital asset pricing model can be transformed into a global capital asset pricing model, and how the corporate can experience the global beta in their pricing of the cost of equity. We will also be discussing about the segmentation and integration of financial market, and how segmentation and integration can play a vital role in diversification of company capital structure. Here, when we mention that international capital structure, we have to understand that prior to 1970 there was no international market. As we discussed earlier session, the gold, the US dollar was linked to gold, and other countries domestic currency linked to US dollar, and there was no development of international capital market, and domestic companies generally source their capital from domestic market itself. After 1970, when US dealing their currency, that is US dollar, from gold, and allow its own currency to freely determined by the market forces, that time the international capital market developed. US deregulated their interest rate, exchange rate, and also allow the domestic company to migrate to different countries. Soon after, many other developed countries liberalize their financial market and allow the domestic MNC to source their fund from different markets. This process leads to development of international capital market. Since 1970, there has been massive cross border capital inflow. Initially, it was international debt in the form of sovereign debt, in the form of international bank, they flowed international debt. This international debt continue to be a significant part of capital structure or capital source for many MNC company. However, after 1980s, the predominant of dollar as a predominant of US currency in the form of international debt reduce, and many country migrate to other part of the globe to source their capital structure. If you segregate the international capital market, it will be two different parts of development. Till 80s it was predominantly debt. After 90s, some extent of debt and equity, but later part of 90 it was primarily equity related capital structure. Many MNC in developing country also source their capital, particularly the equity, from developed market, particularly London and New York market. These two markets were predominantly in the form of equity and debt floated by different MNC of different countries. So, after 90s it was it was equity finance in the form of international source of capital predominantly managed by many MNC. And this change of capital structure from primarily domestic oriented debt to international oriented debt, domestic equity to international equity change the entire capital structure of the company, and this create a different kind of capital asset pricing model which cannot be handled through domestic capital asset pricing model. You have to link the international beta in the pricing of cost of equity of MNC, and this has been a source of finance in at present by many MNC company. When you discuss about the ADR, JDR, how it becomes a indirectly linked to equity, a debt oriented capital, that time we will be discussing when how JDR ADR has become a primary source of raising of equity related debt instrument. Here before discussing about the capital structure, we have to understand that capital asset pricing model. As we know from our corporate finance, the primary way of calculation of WACC of a company, that is weighted average cost of capital. Here a part of the capital from the debt side and a part of capital from the equity side. Equity and debt compose the capital structure of a company, and the overall cost of capital depends upon what is the cost of debt and what is the cost of equity. When you mention about the capital structure, the WACC of a company is nothing but that company, that is cannot will be the cannot here overall cost of capital for a company. It depends upon how much the cost of debt into the part of the W1 here, W1 WD is the weight of the debt in the total capital. Similarly, equity and weight of the equity here. Here WD plus WE is the 1 because it is in percentage total capital of the company. But here you have to understand that debt provide what is called tax relief to the company. So, debt lead to reduction of capital overall cost of capital. Here we have to understand that here when we mention that KD is 1 minus tax rate plus KE into WE. Here T is the tax rate in percentage. So, K the amount of debt reduce the cost of debt in the form of tax rebate. So, this linked to this reduce the overall capital structure of a company. This we in corporate finance we call it WACC or weighted average cost of capital. So, here KO is the weighted average cost of capital where debt and equity are part of the capital structure. Before going to the actual international form of capital structure, you have to understand that the equity provide some kind of leverage effect to the for leveraging or reducing the overall cost of capital. The promoter's holding is the equity, that equity provide as a room to leverage reduce the overall cost of capital by replacing equity by more and more debt. This is called leverage effect of cost of capital, and here we are leveraging the having equity, we are leveraging the debt also. So, when you go for the international capital asset pricing model, you have to price what is called the equity side and debt side separately. From the capital structure model, we understood that the the pricing of a capital asset, particularly the equity, depends upon the risk premium, because when two part of the capital structure is one part is debt, another part is equity. The debt has less risk compared to the equity. Since equity holders are absorbing the risks of the company as a owner of the company, they are supposed to get a risk premium because of their risks. The risk premium linked to the pricing of the cost of equity. So, when we discuss about the cost of equity, we have to understand that you have to price the cost of equity first, then you will go and price the works of the company or estimate the works of the company. To understand that when from the capital asset pricing model we generally assume the cost of equity. The cost of equity depends upon the risk premium and the beta of the company. The cost of equity, the price of the suppose cost of equity is RI, the cost of equity, then we have to understand that a risk free interest rate and the market risk minus the risk free interest rate into beta of the company. Here RI is the cost of equity or return from the equity or the return from the asset of a capital asset, primarily equity here. The risk free interest rate, because if I invest in capital market, I have to, if I have some amount of money, I want to decide whether I should go for capital market, that is equity investment or some other kind of investment, I have a opportunity cost. Because if I go for equity investment, I should get my opportunity cost is risk free interest rate. I supposed to get minimum return, that is risk free available in the market. If I am investing in capital asset in the equity market, I suppose get a risk premium beyond the risk free interest rate. The risk premium depends upon the which equity you are investing. The equity, every equity has a beta. The beta we know that the proportionate change in the price of the equity, return from the equity to the proportionate change in the index return. So, when the company return is increasing, how much percentage increasing with the index of the market. So, the relative return from the equity as relative return of the equity against the market is the beta. The beta, each equity has a beta. When you have a portfolio of equity, we have to estimate the portfolio beta, which is nothing but the weight of each equity in the portfolio. That is, portfolio single equity is that, the portfolio equity is the portfolio asset I1 to n, that is portfolio beta will come over here. Individual beta into the weight of the individual equity, that if you multiply, then you will get a portfolio beta. Portfolio beta in a particular company, there are many equities will be there. So, each equity has a own weight and each equity has a own beta. So, if you multiply the weight and beta, we will get the portfolio beta of the company. So, when you understand that when we are going to invest in equity market, we should get a risk premium, because we are absorbing the risk by investing in the capital market. The risk premium is nothing but the market return minus the risk free return into the beta of the equity. So, here the beta of the equity is the index, the return of the equity against the index. We generally calculate the beta of the equity, as we know in the from corporate finance, the covariance of equity and between the covariance of equity and the market divided by the variance of the market. Here R represents the return. So, suppose our equity asset is I, then covariance of return of equity I in the market, as RM is the market. In case of India, suppose is NSE in return, NSE is the return of NSE, and suppose R is the Reliance company shares, the return of the Reliance company share, the covariance, the relation among these two return divided by the variance of the market. The variance of the market give us what is called the beta of the company. In other words, it will be covariance of RI and between RI and RM divided by variance of the market. Variance of the market, that will provide the equity, the return from the equity. return from the equity or the beta from the market. So, when you take the beta, when you estimate the beta, then after estimating the beta, we know the return from the market, we know the risk free return, you can calculate the return from the equity or the cost of equity indirectly. But here you to understand that the beta is a systematic risk or the market risk of the equity. When I mention RI here, risk free return, market return minus risk free return into beta of I, or risk free return RF is a risk free return, market return minus the equity return into covariance of equity and market divided by market standard deviation, market risk. That will be our beta. Here if this RM minus RI, RF minus RI is the risk premium, because by investing in equity market, I supposed to get a premium nothing but beyond the risk free interest rate. RF is the risk free interest rate available in the market, and this provide us how to price a equity in the market. But when you discuss about equity in international market, it will be different capital asset pricing model, or the pricing of asset will be different from the domestic market. So, why market premium arise? Market premium arise because that the individual is investing in a risky asset, that is equity, and is supposed to get a premium for investing in the risky asset. But the market premium related to the market risk, that is the volatility of the index, and also how much risk the person is going to absorb. As an investor, what is my risk appetite? If you want to absorb more risk, then risk premium will be more. You want to absorb less risk, risk premium will be less. So, the risk premium depends upon not only the volatility of market, but also the risk appetite of the investor. So, generally it depends upon a segmented market or a integrated market. Segmented market, because in a segmented market the free movement of capital is not there. Free movement of capital means there is a capital account convertibility is not 100%. There is a restriction in the movement of capital from one country to another country. If the restriction is there, then domestic capital asset pricing model and the international capital asset pricing model will be different, because since restriction is not there, the returns from the domestic market, returns in the international market will be different. If restriction is not there, then there will be free flow of capital from one market to another market, from one country to another country, and in this way the law of one price prevails. So, that time the domestic market itself is international market. So, when we prepare the capital asset pricing model, we have to understand that whether the country is integrated with the international financial market, or there is a segmentation between domestic market and international market. If it is a segmented market, then domestic capital asset pricing model will have different level than the world capital asset pricing model. So, suppose in case of India, India where domestic capital asset pricing international integration is very less, we have a separate capital market for Indian context and also separate capital market for the world level asset. So, here in case of India, it will be return from the market, that is NSE, return from the equity and beta of the equity, here domestic market. And if you price for the international, the risk free return and market return, the market return is market return minus the here market return become world return, world market return, that is W, I put RW minus the interest mine here beta W. Here RW and beta W are international market return, here international pricing model. It will be international CAPM, capital asset pricing model. So, why? Because when the country not integrated, then domestic market will be separate and international market will be separate. Domestic asset price in domestic market depends upon domestic market risk and the domestic market return. If the international asset suppose price in international market, it depends upon international return and international beta. So, here two different models will come, because the markets are not integrated, they are segmented. There are reservation or the restriction of movement of capital from one country to another country. So, we have in Indian context, if you see, after the current account convertibility is there fully, but capital account convertibility is not fully. So, there is a restriction on the movement of asset, movement of capital from India to abroad and from abroad to India. This restriction provide two different capital asset pricing model in case of India. One is a domestic market, another is a international market. If you are taking into account international equity, the New York Stock Exchange or the Nasdaq or the London market will be the world market for us, but for our own domestic country, NSE may or BSE may be the market return. So, here if you take into account the two different pricing model for India, since Indian market is not fully integrated with the world market system. So, we have a different capital asset pricing model. We have a one domestic capital asset pricing model, where the price of equity depends upon the return, and here RM will be suppose in NSE return minus RI and beta of the RI, and beta of RI will be covariance of NSE return and equity return divided by the NSE market risk. Similarly, it is a domestic capital asset pricing model. In India, India contains, since India is not fully integrated with the world financial system, but in case of world, suppose if we take a equity return of Infosys listed in NYSE or Nasdaq. So, it will be different, the risk free interest rate minus the here RM will be the Nasdaq return minus equity return and beta of world or beta of US. So, here also separate, and beta will be beta of world will be covariance of that covariance between the Nasdaq return and equity return divided by sigma of, that is sigma square of Nasdaq. So, it will be different, because here it is international level capital asset pricing model. Here what we understand here, you understand that the capital asset pricing model depends upon segmentation or integration. If it is a integrated financial system, the domestic capital asset pricing model will be same as international capital asset pricing model. If there is, because there will be free flow of capital from one country to another country, the law of one price prevail in the market, and there may not be any difference between domestic return and international return. But in case of segmented market, they are segmented because of government policy, restriction on movement of capital, and this lead to what is called a different return in two different market. In domestic return we have it differently, and international return also different, and this lead to what is called a international capital asset pricing model. Here you have to introduce here international return and international covariance between equity and return and international market risks both, and this concept segmented and integration generally prevail in all market, because you will rarely find any particular country market is fully integrated with the world financial system. It is not the completely integrated, it is not also completely segmented. there will be degree of integration and degree of segmentation. So, I have mentioned here that when the market is become integrated, we observe that return from domestic market will be same as return from international market, and there is less scope for the company to source the capital from different country. And the domestic capital asset pricing model nothing but international capital asset pricing model. There is no further room to reduce the cost of capital. However, in case of segmentation, there will be scope for domestic for company to raise capital from abroad at lowest possible cost, and this leads to what is called reduction of overall capital cost of capital for the company, and the cross listing of share or cross listing of debt provide some degree of benefit from the domestic company to reduce the overall capital structure, overall cost of capital. And when the capital structure of domestic company internationalized, it is not the domestic beta, but also the international beta who play the vital role in deciding the cost of equity and overall cost of capital for the company. To understand that integration and segmentation, two extreme sides, you cannot have completely integrated, you cannot find a particular country completely segmented. So, there is a degree of integration and degree of segmentation, and always there is room for company to reduce the overall cost of capital by diversifying their domestic capital structure and putting international debt or international equity in the domestic capital structure itself. So, when they diversify the capital structure by internationalizing the equity and debt, this provides a difficult situation for the company to handle the overall cost of equity. It may happen that company may lose some degree of independence, some degree of corporate decision making process by diversifying their equity base, because when you internationalize or cross list your equity, then international pulls and pressure affect the corporate decision making process, and this provides some degree of restriction and some degree of what is called barrier for the company to over emphasize on the international capital structure. So, when you discuss about the benefit or the what is called difficulties in international capital asset pricing model, you have to understand that the benefits are sometimes more than the what is called the problem of difficulties in the international aspect of capital structure. The benefits are expansion of investor base. When you cross list the company, a particular company cross list this equity, they provide a large pool of investor. The large pool of investor provide what is called more liquid to the company assets or company equity. The liquidity or the aspect of company may increase, because their shares will be listed in different stock exchange of the world. So, the secondary market trading will increase, and large investor pool also provide more liquidity to the company equity. Similarly, the company viability or the visibility of the company also increase, because it enhance the corporate governance of the company, and company try to improve its corporate governance, because they know that their shares are listed in different stock exchanges. This provide the market kind of what is called market pressure on the company to perform well. That also the market visibility provides some extent of extra pressure on the company to become more viable, to become more efficient and productive in handling the company day to day balance sheet. The company will be in pressure to provide more profitability for the investor and the shareholders. However, there are many such kind of disadvantage in cross listing of equity or more emphasis on the diversification of international capital structure. Here company has to disclose the high disclosure norms as per the requirement of the regulatory requirement of the different stock exchanges. Company has to manage the corporate governance, and also there will be international investor, international level of director or ownership in the company day to day basis. The international ownership or the international director may influence the decision making process of the company on the every moment. The foreign ownership may influence domestic decision process also. The higher the cost, higher cost of market volatility, and it may negatively affect the company domestic operation. It may happen that the international volatility will also come to the company day to day decision making process, because stock markets are highly volatile. The international volatility may also affect the cost of equity of the company. There will be more demand on the part of the investor for provide more dividend, and also provide pressure on the company to perform well in the capital market. So, definitely there are number of difficulties, there are number of positive benefit for internationalization of capital structure of a domestic company. So, when you mention that there is a internationalization of capital structure of domestic company, you have to understand that how to estimate the capital structure, what are the pulls and pressure, what are the other variables which influence the capital structure of domestic company. Here I mentioned earlier that the beta is when a company cross lists their share, the beta will be covariance of market and in a company return divided by market standard deviation of the market risk. Here RI is equal to, that is equity of that cost of equity will be the cost of risk free interest rate minus the market interest rate and beta of the equity. So, further you can write here risk free interest rate RM minus RF. Here I put the beta value covariance of market and RI by variance of market by standard deviation of the market. So, when you go for further, I can mention here that RF and RM, the risk premium and covariance of RM and RI. This just I readjust the equation, and I can write here risk free interest rate into a covariance of RM and RI, where AM is this part. This part is AM. In other word, it will be nothing but what is we are doing a separate calculation process, where I am mentioning here some degree of what is called a separate variable AM. AM is the value, this is the value of AM, and this is covariance of RM and RI. This AM tells us the risk premium divided by volatility of the market. The risk premium, that is RM minus RF plus divided by volatility of the market volatility, that is AM for my sense. This equation aggregate risk aversion measure. AM also nothing but aggregate risk aversion measure. How much risk aversion, that is this is what is called, this part is nothing but the risk premium divided by the volatility of the market. This part we are calling AM. AM is the aggregate risk aversion index. Aggregate risk aversion index we are putting separately. If you see in a here, the AM here I mention AM here risk premium, the market risk minus the risk free interest rate divided by sigma of the market is called the risk to volatility index. Risk to volatility index, or any other word we call it aggregate risk aversion index. Risk to volatility or aggregate risk aversion measure risk, and this if you put in a separately, it linked to covariance of market and individual equity or the that along with the risk aversion index provide us that is called the international capital asset pricing model. Then question is, what is this? When we put separately, in put separately fully integrated capital market, each asset will be priced according to the world systematic risks. If the market is 100% integrated, there is no scope for no barrier for the movement of asset, the movement of capital, then this AM become AW. In other words, when the market is fully integrated, there is no scope for any kind of barrier in the movement of capital from one market to another market, then this will be separately calculated. I put here RI RF plus AW into covariance of world and RI. Here AW is the aggregate risk index, that is RW minus RF by sigma W square. Then when the market is fully integrated, there is no scope for a barrier for a capital movement. This will be the market beta or global beta. This will be global beta for us. This will be global beta for us, and in this case, each asset will be priced as per the market, as per the international market, because this kind of this kind of thing we will never find in real world. What is called entirely 100% integration, 100% integration and 100% segmentation. This rarely is find in real world. This 100% integration means each asset will be priced as per its world systematic risks, but 100% segmentation is each asset will price as per the domestic market risks, but this is rarely happen. Market will be some extent here either some degree of segmentation and some degree of integration, somewhere the asset will be here, and both domestic beta and international beta influence domestic beta and international beta influence the capital structure of a particular company. So, when you mention that 100% segmentation and 100% integration is not there, it will be in between these two. The international capital asset pricing model is not valid in a, if you say in a larger sense. Similarly, also domestic capital domestic beta also not valid in a larger sense. Some extent the both domestic beta and international beta influence the portfolio of the particular company capital structure, and therefore, we have to take care both sides while pricing the asset of a asset at the international market. So, when you observe that if asset is listed in domestic market, at the same time same asset is listed in the abroad international market, the cross listing, you have to see which market beta is more powerful, whether is domestic market, investor is pulling the beta of the company, or the international market investor pulling the beta of the company. It depends upon whether there is a free flow of capital or restriction of capital. If there is a some extent of restrictions are there, it may happen both asset will be both beta will be different. However, the different may not be there for long time. There will be some extent of pulls and pressure, and in the domestic investors are able to purchase the abroad listed company shares, or the abroad investor able to purchase domestic market companies equity, then the differential price or arbitrage opportunity will be reduced over the year. Because if you see that nowadays FIs are investing both Indian domestic market, also in abroad market. In the stock is listed in both market, one in India, another in abroad market. The FI take the advantage of any kind of arbitrage opportunity, and definitely the beta will be come down to the particular level where domestic market beta and abroad market beta will be almost same as except the transaction cost. So, both will be almost same, and there may not be any differential arbitrage available to take advantage of the price movement. Therefore, then in case of a cross listing of share, because of the movement of capital or movement of FI or the movement of investor from one market to another market, bring the beta at the global level, or where there may not be any arbitrage opportunity for individual investor to take advantage of the two different price level. Therefore, in case of cross listing, both the domestic market and also the foreign market pulls the beta to a particular level. Therefore, you have to understand that in case of segmentation and integration, these two are extreme case, and in between the beta will be price or the equity will be price as per the what is called strength and weaknesses of investor in the economy or the in domestic market, also in abroad market. So, here the AW indicate the risk aggregation index, or the what another word I can call it as a global systematic risk. The AW capture the global systematic risk, where the risk premium is here, the premium against the volatility of the world market. This capture the global aggregate risk index. So, when we use this concept, in pricing of the asset or pricing of the equity asset, you should understand that this concept allow us to estimate the global beta. This concept allow us to estimate the global beta of a company, where the company cross listed in many exchanges or more than one exchanges, in particular more than one exchanges in as per the pricing of their asset. This is the global beta we have to estimate that. So, here the foreign exchange market play a vital role, because the global beta influence the exchange rate also, and also exchange rate is being also influence the global beta also influence the exchange rate. So, exchange rate risk also factor in global beta itself. So, when you actually use in pricing of asset, we should understand how to price the cross listed share, the cost of equity or the works of the company. So, when through an example we will do the same thing. Let us see the example here. The example is here, to compare the US dollar cost of capital for IBM and Sony. If US dollar risk free interest rate is 6%, global risk premium is 4%, and IBM and Sony's global equity beta in US dollar itself 0.83 and 1.66 respectively. Here what we have given to us, you have to price the cost of equity in terms of US dollar, for IBM and Sony. So, we have two company, one company is IBM, another company is Sony. They are international company, their equities are internationally listed in different stock exchange. You have to find their cost of equity in US dollar. So, what given to us, risk free interest rate both in US dollar. Risk free interest rate in US dollar is 6%. This will be same for Sony and same for the IBM at 6%. It does mean US dollar risk free interest rate, that is any particular risk free interest rate of US dollar as 6%. Then we have given to us that risk premium, the global risk premium. We have global risk premium given to us. global risk premium at present 4% in US dollar. Global risk premium is 4% in US dollar. So, and also we know that in case of IBM, the beta of IBM in US dollar proportionate US, because it listed in US. So, global beta of IBM in US dollar, beta of IBM and Sony global equity beta, in case of IBM it is 0.83, and in case of Sony the global beta of Sony in US dollar it is 1.66. This is given to us, but we have to price what is the cost of equity of IBM in US dollar, what is the cost of equity of Sony in US dollar. We know that cost of equity calculation RI is equal to, suppose it is Sony IBM we are doing, IBM is nothing but we are calculating in US dollar, cost of equity of IBM in US dollar will be risk free interest in US dollar plus the risk premium, global risk premium I put the RW in US dollar minus risk free interest rate in US dollar into beta of world beta or the in US dollar of IBM. If you know this, then you can price the cost of equity of, you can estimate the cost of equity of IBM. Everything we know that in case of risk free interest in US dollar is 6%, global risk premium is 4%. So, global risk premium is this one for us, because risk premium nothing but the differential amount of market return and risk free return. So, we know that risk premium in is 4% into beta of IBM, that is world beta of IBM in US dollar is, we know that beta of IBM 0.83. If you multiply this to 3, we will be getting that IBM cost of equity, that is 9.30 percentage. Similarly, you can calculate the Sony case. Sony will be till how much? So, same thing. So, here same formula I have to use, that in case of Sony equity return in US dollar will be risk free interest rate in US dollar plus risk premium, that is risk premium of risk premium we also know, and beta of Sony in US dollar also you have to understand that. So, here we know the 6%, global risk premium this much is 4% and Sony beta is equal to 1.66 given to us, this will be 12.60 percentage is the cost of equity of Sony company in US dollar, cost of equity of Sony company in US dollar. What does it mean here? Because Sony company listed in particularly different market and you are estimating the cost of equity of Sony company in US dollar is 12.60%. Cost of equity of Sony company in US dollar is 12.6%. The question is here, the risk premium is given to us, the global risk premium, that is US dollar return, US dollar, that is NYC, maybe in NYC return minus the risk return of the US, the risk premium given to us. For that reason, we are in a position to estimate it. Now, similarly, another example if you can do that, here it is a very big example. So, you have to calculate the workshop for IBM, works for IBM in US dollar. So, what are the data given to us? The data is here, we have given, you have to estimate the works of IBM. Works means works is weighted average cost of capital of IBM MNC company in US dollar. You have to estimate that in US dollar. What is given to us? Given to us here, out of total debt, the IBM has 100 million debt. Out of total debt of 100 million, it is 50 million in the IBM has debt, how much debt? IBM has debt of 100 million in US dollar, and this 100 million in US dollar have two parts. One part is 50 million US dollar yield 8% and 50 million is yen denominated debt yield 2%. So, debt represent 25% of IBM capital and effective tax shield of IBM is 33%. Risk free interest rate in US dollar is 6%, while it in year it is 2%. IBM's equity portfolio beta is 85.85, global market risk premium is 4%. So, 100 million debt is 100 million debt total debt, and total debt 100 million divided into two part. One part is in US dollar, one part in US dollar 50 million, and its cost is 8%, and another part is 50 million US dollar, but it is in yen 50 million US dollar, but yen denominated cost. The cost is in yen. The 50 million US dollar is amount, but cost the company is paying in yen return, that is Japanese yen debt, that is 2% in yen. So, and the debt is the company debt amount is company capital structure, debt is 25% and equity financing is 75%. This total 100% is financing pattern. So, debt financing is 25%, equity financing is 75%. Now, risk free interest rate given to us, that is in US dollar 6%, and while yen it is 2%. IBM equity portfolio given to us 80.85 and global risk premium 4% given to us. How you can estimate this? Because here you have to estimate the WACC of the company. The WACC is nothing but the debt part of cost and equity part of cost, total will give the WACC of the company, weighted average cost of capital. So, you have to see that in the case of WACC, the cost of yen in debt plus forex market change of yen, we have to estimate the yen debt cost first. Yen debt cost first, because the $50 million debt is given to us, but 50 million in dollar debt which is denominated in yen is not given to us. So, we have to understand the yen related debt cost first. So, yen related debt cost 50 million is there, that debt is 2%. However, the risk premium in the market is 6%. So, whenever there is a change in yen and change in dollar, the dollar or yen, the relationship that is called interest rate parity is 8%. That interest rate parity, you have to understand that say 6% is risk free interested in US dollar and 2% risk free interested in yen. So, interest rate parity, on that basis yen cost will change. So, the interest rate parity is 2%, 6 minus 2% is a 2% interest rate parity. So, the debt part you have to understand yen, you have to estimate in US dollar. To understand that US dollar cost of yen will be the interest rate parity in US minus interest rate in yen plus you have to understand here the two separately coming, that what is called yen debt cost plus yen debt cost. That will be the cost of US dollar in yen. So, it will is interest rate parity 6% in yen and US dollar 2% in yen and yen debt is 2%, though the cost of yen debt in US dollar will be 4%. So, here if you see this is 8% 50 million and 4% 50 million. So, the cost of debt 100 million debt will be how much? The 50% into 8% plus 4% of weight into 4% also at the rate of 4% at the rate of again 50%. That is the cost of debt. In cost of debt, what it mean? The cost of debt is here debt in dollar into cost of debt plus debt in yen, debt in dollar in cost of debt 50%, that will give you the total cost of debt in yen. So, the total cost of debt if you see here is 8% and 6%, 7%, and estimation of IBM equity as I know everything given to us 6%, 0.85% and 4%, 9.4% is the IBM cost of equity. Similarly, cost of IBM works is equal to debt cost and minus 1 minus t. If you see the here 1 minus t the tax rate, debt cost already calculated 7% and debt cost debt already calculated 7% and 25% debt is there, 25 into 7% 1 minus 33%, that is cost of debt reduced because of tax, and 75% into 9.4 0.822%, this is the cost of works of the IBM company. So, some references I have given to here, you can go through the references, and some model question I prepared for you. You write in detail the international aspect of cost of capital, describe in detail the international aspect of pricing model, the both you have to describe, write in detail about the cost of capital and describe the international capital asset pricing model. Similarly, how segmentation and provide scope for diversification of cost of capital, you have to discuss about that. And I have given a small problem to you, compare the US dollar cost of capital for Coca-Cola and Kellogg. If the risk free interest rate 5.75, global risk premium is 4%, and Coca-Cola and Kellogg global equity beta in US dollar 0.85 and 1.55% respectively. You calculate the estimate the cost of equity for Coca-Cola and Kellogg separately. Thank you.